The de-dollarization has been talked about for decades. The reason no one takes it seriously is its failure to come into fruition. The US dollar remains the number one reserve currency of the world. However, the current move of the BRICS nations, Brazil, Russia, India, China, and South Africa, and now 20 new member nations to bypass the dollar and use their own currency is what spells the difference, and we will discuss why. The US dollar's biggest leverage is oil, according to the US Energy Information Administration, International Energy Statistics. The U.S. is the number one producer of oil in the world, followed by Saudi Arabia, Russia, Canada, Iraq, China, UAE, Iran, Brazil, and Kuwait. According to multiple sources, oil is the most consumed and traded commodity in the world. In fact, the Observatory of Economic Complexity, or OEC, an online data visualization and distribution platform focused on the geography and dynamics of economic activities, estimates that we exported $83 billion of refined petroleum in 2021, the latest available data. The problem is that we consume almost as much as we produce. We produce just over 20 million barrels per day, and we consume just under 20 million barrels per day. We are the number one consumer of oil. Next is China, India, Russia, Japan, Saudi Arabia, Brazil, South Korea, Canada, and Germany. In total, the world consumes 97 million barrels per day of oil. And this is where it gets tricky. The US dollar's value managed to remain elevated even after breaking away from gold because of the demand. Countries want the US dollar and they demand it because top oil producing countries, including Saudi Arabia, Russia, UAE, Brazil, and others, want to trade using the US dollar. According to the U.S. Energy Information Administration, Saudi Arabia is the world's largest oil exporter and plays a crucial role in the global oil market. The country is known for its massive oil reserves and its ability to influence oil prices through its production decisions. In 2021, it led the world with $138 billion in oil exports. That represents 14.5% of global oil exports. It also remains the top oil producer in the Organization of Petroleum Exporting Countries, or OPEC, producing 12 million barrels of oil per day, or about 12% of global output in 2022. Other top oil exporter countries using the US dollar were Russia, which accounted for 11.8% of global exports, totaling $113 billion. Next is Iraq, with $72 billion in reserve and exporting 7.5% of all oil exports. The United Arab Emirates, a small country approximately the size of South Carolina, exported $58.5 billion worth of oil in 2021, accounting for 6% of the global oil exports. The UAE produced 4.24 million barrels per day in 2022, accounting for 4% of global output. Brazil is the 10th largest exporter of oil in the world, exporting $30.7 billion worth of oil in 2021, accounting for 3% of the world's total. Saudi Arabia, Russia, UAE, and Brazil, four of the members of the BRICS, account for approximately 30% of the world's exports. That 30% is the dollar demand that could potentially go away. BRICS's move away from the US dollar has been building up in the last several years. What pushed it into action was the United States imposing all-encompassing sanctions against Russia following that country's invasion of neighboring Ukraine. It shook the world awake to the fact that a nation could freeze their funds due to any sort of diplomatic or military dispute. That didn't sit well, and they took action. The US dollar now accounts for 58% of foreign exchange reserves held by overseas central banks, a record low. Gold, the most ancient, widely accepted international currency, has chipped away at some of the dollar's dominance, accounting for 15% of reserves, up from 11% 5 years ago. Oil stands as one of the world's pivotal and extensively exchanged commodities, historically denominated and traded exclusively in US dollars. This practice has bestowed upon the US dollar a prevailing position within global financial markets, obliging nations seeking to procure oil to initially secure US dollars for this purpose. If oil trading were to transition away from the US dollar, it would have profound consequences, notably diminishing the demand for US dollars, thereby leading to a devaluation of the US currency. This could trigger a series of interconnected effects on the global economy, most notably a substantial surge in inflation within the United States and the potential for unsettling disruptions in financial markets. Moreover, a shift away from the US dollar in the realm of oil trading could usher in heightened economic and geopolitical rivalry among nations. Should the yuan, for instance, gain broader acceptance in oil trading, it might significantly augment China's economic clout and global influence, thereby challenging the United States' supremacy in major global affairs. These transitions are not mere theoretical concepts, but are actively unfolding in real time, necessitating investors to consider revising their investment portfolios. In the event that oil were to be priced and traded in alternative currencies, investors would be exposed to currency risk, as fluctuations in the currency's value could impact the worth of their investments. Consequently, investors would need to assess the potential repercussions of currency fluctuations on their portfolios and make necessary adjustments. Furthermore, there exist industry-specific risks. Companies reliant on substantial revenue from oil production or related services would be directly affected by shifts in the trading currency. Investors holding stakes in such companies would need to evaluate the potential consequences of a departure from the US dollar on their investments. Oil serves as a critical input for numerous industries, and variations in its price can reverberate significantly throughout the global economy. A shift away from the US dollar as the primary trading currency for oil would not only affect the global financial system, but also generate ripple effects across the world economy. For investors dedicated to long-term wealth accumulation, it is imperative to remain vigilant regarding the current decline of the US dollar's influence rather than relegating it to a future concern. If you want a comprehensive report on what could happen to the US dollar in the view of the BRICS de-dollarization and how you can protect yourself against the US dollar crash, click the link in the description box. This has been Ivory Hecker for Noble Gold News.